Welcome to the next in a series of webinars brought to you by PKF Texas. We were pleased to welcome Kristin Ryan of PKF Texas, Cameron Barghi of Nova 401k Associates, and Laura Ferguson of Locke Lord LLP to discuss regulatory updates, recent legislation, and your retirement plans. This presentation was recorded live on February 10th, 2021 as a Zoom webinar. All information was accurate and current at that time. Those viewing this recording now are not eligible to receive CPE credit from PKF Texas. If you have any questions regarding this webinar or future PKF Texas webinars, feel free to email us at jlemansky@pkftexas.com and we will get back to you as soon as possible. Welcome, everybody, to today's regulatory update, recent legislation, and your retirement plans. Thank you for joining us today. We've got a few housekeeping things. Everyone who attends this live webinar today will receive CPE credit administered by PKF Texas. In addition to attendance, you'll need to answer at least one of the polling questions that the panelists have prepared today in order to be eligible for CPE. The panelists are happy to answer questions throughout the presentation in addition to the Q&A time at the end. So please submit your question through the Q&A button at the bottom of your screen and make sure to indicate who you would like to answer your question. I'll go ahead and introduce our panel today. We have Kristin Ryan, a senior manager on our audit team at PKF Texas. She leads the employee benefit plan audit and advisory practice with a growth-minded effort. She has extensive experience focused on employee benefit plan audits, primarily 401k and pension plans. She's been with the firm for over 13 years. Cameron Barghi is a retirement consultant and shareholder for Nova 401k Associates. He has experience in plan administration for defined benefit and 401k plans, including annual compliance testing, 5500 reporting, and plan design consulting. And finally, we have Laura Ferguson. She's a partner in the Houston office of the law firm of Locke Lord LLP. She advises clients on a wide variety of employee benefits, executive compensation, and privacy and cybersecurity matters. Welcome, everybody. And we're going to kick off with a polling question so we can give our panelists a feel for who is actually in the audience today. So we're going to have you guys let us know what your position within your company is. So if you'll take a couple seconds to fill that out, it looks like we've got some CEOs, some CFOs, some HR professionals, some plan administrators. Looking like a good group here. All right, we'll give it another minute for the votes to file in. Okay, we'll share the results so everybody can see who's in the audience. And with that, Cameron, I'm going to turn it over to you to get started.
Sure, I appreciate that. And everybody, thanks for joining me. I'm honored and excited to be a part of this panel with experts like everyone else that you can see in front of you. And so my role at Nova, again, is a retirement plan consultant and shareholder at the third-party administrator level. And what I wanted to touch on initially, something we're getting a lot this time of year, are questions around CARES Act, which passed in conjunction, with providing relief to COVID, and sort of a debrief, if you will, on what went right, what went wrong, what did we experience all right there at the end of the year. And I'll say this, on the TPA side of things, it was a really exciting challenge. It was an interesting challenge. We found that so many different parties needed to be on the same page to make the execution of everything that became available possible and efficient. When CARES first came out, suddenly all these provisions became available, and none of us at the TPA level really even knew how to initially execute on those things. For example, where things were passed, we didn't even have the initial approved verbiage to make the amendments, right? And so there was a delay there in us being able, from a compliance standpoint, to be able to actually implement these things. On the provider side / record keeper, if you will, everybody, it was a fire drill to put together the actual distribution notices that had the self-certification box, get all that passed through compliance. And so you had that initial long line of people that really needed to take a COVID-related distribution, and they were all in a waiting room, if you will. I think in talking to our loans and distributions team, one of the biggest struggle was in the first draft of distribution forms that came out, there wasn't a place to mark how vested you are, or your termination date if you had left, right? And so for all of us to be able to track that and make it all possible really was difficult. And as we all kind of started putting it together, then came the final influx of everyone that wanted to take it or needed to take a COVID-related distribution right there at the end of the year. So for those of you that are on this call or this webinar, if you will, that were a part of that process at the plan sponsor level, you probably felt that from your TPA partners, your record keeper partners. What were the hard deadlines we were going to put into place? Were we able to get past some of those deadlines and add a little big wiggle room? Some cases yes, some cases no. But I think sort of the end all be all lesson we took away from that was simply this: everybody needs to do a better job setting expectations of, here are the timelines, here's when you have to be able to do something like this, and understand if you wait until the last minute, that much needed distribution might not be available. So we might have to go a hardship route or possibly a loan route. So in regards to a debrief with CARES, if you will, that's really what we're feeling. And then, with a big update on Secure Act, which is the other big act that passed right before CARES, and it was kind of unfortunate because there were a lot of great things tied to that then became overshadowed with the CARES coming out immediately after. Normally Q1 at the TPA level, it's more things admin than it is new business. But right now it's chaotic because Secure Act is allowing people to now apply a plan retroactive to a prior year, to be able to go safe harbor in a prior year, and all kinds of neat and different available plan provisions where 2 years ago, if we were having this conversation, they wouldn't be available. So still changes in the regs, a lot of things retroactive, a big time debrief on what happened last year. And we'll touch on some more of that later on if given the opportunity. So I'd love to pass it to Laura, maybe have her add on a little bit and add some color to what I was just mentioning.
Sure. Yeah, I think from a CARES Act perspective, we found many of our clients just didn't, implement any of the kind of special provisions just because everything was rolling out so quickly. They didn't really know what was going to go on with their workforce at that point. And so, those things just didn't happen. I think from the Secure Act perspective, what we really saw was the third-party administrators, reaching out to our clients saying, hey, here's our default operations. And if you don't respond by X date, this is now what your plan does. And, for some of our clients, they paid attention to those emails and we got phone calls or emails saying, what should we be doing? Should we opt out of these things? Should we, go with them? But we had a lot of clients that just, didn't get the email, right? So they're in the default and now we're just working with them on, okay, so what have you done operationally since Secure Act came out? And then that's what we need to document going forward. If you went with the default, the third-party administrator provided, they're going to probably give you the form amendment. You're likely on their prototype document and they're just going to give you their standardized, here's our amendment, here's the default, and you just, review it with your attorney and then get that adopted, which, the adoption date is way in the future. So that's the big question there. I think, a lot of our clients that had other amendments to do, we started working in the Secure Act amendments, just things like the age 72 for RMDs, required minimum distributions, but noting that the 2020 RMDs were waived. I think what else was going on? Yeah, I think that's about it for kind of what we were seeing with clients. It's kind of like Cameron said, a non-event because of the overshadowing of the CARES Act. So I think we can move on to our first polling question. So do you feel you have a good handle on how CARES or the Secure Act affects your plan? Yes, no, or not sure? Which I feel like not sure really puts you in the no category, but we wanted to give you some flexibility if, you think you get it, but maybe not.
The answers are coming in fast and furious. We'll close the poll here in just another second. All right, end polling, and there are the results.
All right, so it looks like there might be a lot of questions out there. And if you guys have any particular questions on Secure CARES that you want us to answer right now, feel free to submit those in the Q&A and we're happy to try and address some of them before we move forward. I don't know if we have any submitted.
Doesn't
Nothing is,
look like we have any yet. So I can keep moving and we can address any questions as they come in. That's interesting, interesting results, especially after you teed that up, Laura, with why we put not sure. It's a good thing that we did. So that's why we're here today. Hopefully we're going to clear some of these things up for you. And obviously feel free to reach out to any of us after the presentation as well. So I wanted to talk about the Consolidated Appropriations Act because that's the new one now that we have in our hands. So as of December 27th, 2020, and it enhances CARES. And there are some provisions that you're probably interested in that we're not going to cover today, but I'm sure you're hearing about, like the PPP loans, tax credits and deferrals, and some health and dependent FSA considerations. But we're going to focus on retirement plans today, obviously. So the big thing that came out with this in our world is the partial plan termination relief. So a lot of you know that partial plan terminations generally, if you have a reduction in force of 20% or more, there is a lot of gray area with it. I always have to caveat with our clients need to discuss this with their ERISA counsel. If you don't have one, we have some great people that we work with like Laura that we can refer you to. It's never a good idea to go about that alone. But there is some relief. So if you did not declare partial plan termination, you may be able to avoid doing that under the new rules. So it does consider furloughs, layoffs, and terminations. So I want to make that distinction because there are specific rules around whether or not furloughs count and things like that to consider. So that's why we advise you to talk with an ERISA attorney to make sure. But essentially, this gives you a 3-month extension. So if you hadn't declared by the end of 2020, you do have until end of March of this year to figure out whether you actually had a partial plan termination or not. And so the new rule is if your number of actives that are covered by your plan on March 31, 2021, so this coming March, is at least 80% of actives covered by the plan back on March 13th, 2020. So it's a flip between the 13th and the 31st because of when COVID hit. So that gets a little bit tricky, but it's if during COVID, March 13th, 2020, whoever you had to lay off or furlough or terminate at that time, you have to have hired back and be at that at least 80% mark by March 31st, 2021.
Just one clarification on that point is you don't have to hire back the same people. So you can be hiring new people to fill, roles so that your numbers are coming up. So it's not, if you furlough someone, you just haven't brought them back. If you hire someone else, that's going to count too. So just wanted to clarify that.
Thank you. Thank you, Laura. That's why we have you here.
And then is there anything else you were going to say on that, Kristin? Because I was going to say a couple of things I've been talking about with some.
Yeah, please do. No, I was just going to clarify again that, the three of us convened before this, obviously, and we decided that, there's no guidance out there right now that indicates that you can revoke that. So once you've made that declaration, you really can't do anything about it at that point. Likely, obviously, it probably depends if you've actually affected any participants' accounts yet. And then the only other thing I was going to mention is in that 20% calculation that I was talking about earlier, that's the rule in any year. You do have to consider the employees that are affected are the ones that were terminated during the year that the declaration was made. So it's anyone that was terminated during that year and has an account balance. Those are the people that become 100% vested under the partial plan termination rules. So that's how it affects your plan is if you do have a plan that has, a lot of unvested, then those people become immediately vested.
Yeah, exactly. So, that one of the things that we usually recommend to clients is, you wait till the end of the plan year before making a declaration, just because a lot of things can change. And it's a facts and circumstances analysis as well. The 20% is kind of presumed target number, but you have to look at kind of the reasons for it. I think in this last year, it's pretty clear most of this was COVID. So, that's going to be likely the reason. So anyone that's kind of impacted by that throughout the year, and we also have the concept of this like rolling partial plan term. So it can cross into the next year as well. So you can't just cut it off necessarily at December 31st of 2020 and look at it. You actually have to, if you guys continue to do, terminations into, January 21, it's like related back to COVID, you can't factually distinguish those two years. That could also bring you into a partial plan termination. But something I talked about with my my partners yesterday, because I just wanted to check in on, my feeling was if you declared it, you probably can't take it away. And so we had a little debate about it. And, one of them said, technically you don't have to amend the plan for the partial termination. And so Code Section 411D6, the cutback, anti-cutback provision, would not likely apply in this situation. So the exception to that would be if you went ahead and fully vested everybody and told them, hey, we had a partial plan term and now you are 100% vested in all of this, and you notified them that that happened, probably we're not going to be able to walk that back unless the government comes out and says, hey, what we're saying is you cannot declare a partial plan termination if you were back, below 20% after COVID. We don't have that guidance yet. We probably won't even have that guidance for like a year. And I think it's going to be a nightmare for people to like unring the bell, like unwind everything. A lot of these people probably took their accounts already. And if you had fully vested them, they got to take it. I know some of our clients, left the money in the account, like as if they were going to be fully vested. If they took their accounts, they couldn't take out the amounts that were under this kind of pending partial plan termination designation because they were waiting to see if guidance came out. So we're hopeful guidance will come soon so we can figure out this issue. When you read the Consolidated Appropriations Act language, it sounds like it is a mandatory if you're under the 20% by that date, that it is not a partial plan term. And that just kind of, it doesn't really work with a determination that was made in a prior year before that law came out. So they're going to have to address how they want people to handle this. And you can have a partial plan termination that's under 20% as well. So that's where they kind of didn't get into that detail where, facts and circumstances could show that 15% was a partial plan term. So basically we're saying it's a wait and see. If you have done it, you probably can't undo it, but maybe you have to if the government says you do.
Yeah, thanks, Laura. Absolutely. So I think we have a couple of polling questions we wanted to bring up on partial plan termination specifically. So the first one is, did your plan declare a partial plan termination in 2020? Yes, no, or not sure. And then the follow-up is, do you plan to use the partial plan termination relief? Yes, no, or not sure. So do you feel like you're going to be able to take advantage of that relief, or do you feel like it's kind of just already done, like Laura talked about, and probably too late? So we'll give it a second to get some responses in. So it looks like for the first one, did your plan declare partial plan termination? Surprisingly, no one says yes. Most say no. And then about 10% say not sure. So that's good news. So if you didn't and you feel like you might be in danger of that, you have some time to rectify that before March. And then do you plan to use the partial plan termination relief? Of course, given we had mostly no on the first one, we have mostly no on the second one. So that seems to track. Thanks for participating in that. And then I am going to pass it back to Cameron. I think we're going to see if we have any questions that have come in from the audience today. And then we do have some safe harbor items to talk about, if not.
Seeing any questions? Well, I'm gonna transition away from what you said, but in a smooth way, if you will. We fielded so many calls in 2020 with the anticipation of the slowdown in business and trying to avoid the furloughing and the termination of employees, and what could we do? And there were a lot of things we would initially do, like, hey, listen, if you make a match, for example, and your document is written to make that match payroll by payroll, there is a grace period in regards to having to make that match. And the regs allow us to change the match frequency from payroll to an annual basis. So for those people that were concerned about, less concerned about matching, more concerned about, hey, we're just trying to keep everybody on the payroll. We did a lot of amendments there where instead of jumping people out of safe harbor, for example, we just rewrote the document to delay their match into the next year for the prior year. But the reality is a lot of people had to jump out of safe harbor for obvious reasons, or a lot of plans we initially signed did not want to go safe harbor and commit to a fully vested, required preset match for obvious reasons. And so now as we sit here today, we're really reverting back to the Secure Act and a lot of the safe harbor flexibility and enhancements that are available right now during testing time. As we all know, the TPA does all the compliance testing this time of year for last year. This is when we unfortunately come to a lot of plan sponsors and say, you have failed your testing. And a lot of people don't know what that means because they know there's a lot of different tests out there, and some of them are dependent upon things like what we call top heavy, things like deferral percentages, coverage testing, things like that. And so one very popular provision that Secure Act is allowing for now that we're seeing is the ability to apply a safe harbor provision to 2020 retroactive. You finished out your 2020 plan year, somebody's starting to plant this seed out there that your plan might be top heavy, or you're going to fail some type of test, and we've always referred to safe harbor as sort of the free pass, right? You're going to pass almost every test that's out there other than the annual additions test, and the tests apply to everybody's own individual limits. So we're getting a lot of people that are saying, well, wait a minute, you're telling me I'm going to be top heavy. You're telling me that I'm going to fail my ADP test. I'm going to have to start to talk to people about refunds. A year ago, there was nothing we could do about that other than help you figure out a way to kindly communicate that. But now we're in a point where we can actually apply a safe harbor non-elective provision to 2020. It's not like the normal safe harbor non-elective 3% that you'll see a lot of times in conjunction with a new comparability profit sharing plan or some type of defined benefit or cash balance plan. It's actually a safe harbor non-elective 4%. So in order to be able to use the Secure Act to go safe harbor for 2020, as we sit here today, you would commit to a safe harbor 4% non-elective. Now, as we sit here today, you would then be able to revert back to a 3% non-elective in 2021. And then as 2021 goes, if it turns out that you would want to switch over to maybe a safe harbor match, that could be a conversation we have towards the end of the year for next year. So that's one very popular provision we're seeing that the Secure Act allows for, that people are jumping all over given its testing season. We're seeing a lot of people use the other sort of provision that the Secure Act is allowing by allowing you to go non-safe harbor to safe harbor mid-year. So in the past, if you started safe harbor, you were safe harbor throughout the entire year. And now you've got the ability to be in your year, and at any point in this year, jump from a non-safe harbor plan to a safe harbor plan. The only option out there is a non-elective 3%. But as anybody that's on this webinar that has been top heavy, we all know that more often than not, the fixed being top heavy is giving everybody a top heavy minimum of about 3%. So if you get through this year and someone's telling you that there's the chance you're going to be top heavy, instead of waiting and giving everybody the required 3%, you might as well jump into the safe harbor 3% now, so you can go ahead and pass some of those other ADP tests and ACP tests and et cetera. So that's a really popular provision that we're seeing our sales guys, if you will, talk about. The account managers are talking about them. Lastly, I know there's not a lot of people on here. I'm assuming everybody else has a plan already, but we are getting some people that have humored the plan option or are humoring a safe harbor option, wanting to know if all of these changes or if all these provisions that came out are changing the safe harbor timing requirements. And that answer is no. So if you've never had a plan and you're considering having a plan, the rules still say you have to be up and running for at least 3 months in your first year if you want to be able to be safe harbor and you don't currently have a plan. So, but again, I don't know that that's too applicable to everybody on this call. So again, the two main things we're seeing people do that have a plan already is if you feel like you're having testing issues for 2020, there is some safe harbor relief you're now allowed to apply retroactive to that. And if, as you sit here today, you're not safe harbor, and for whatever reason you might have out there, you might be considering a safe harbor provision, talk to those of us that are on this call, talk to your current advisor, your current TPA, and see if safe harbor makes sense, because now you've got the ability to jump to safe harbor mid-year. So that's pretty much the updates that Secure Act allows safe harbor. Lori, I'll pass it to you. Anything you want to add? Anything you guys are seeing on your end relating to that?
No, I haven't had anybody reach out yet on doing a retro safe harbor plan. It might come up as, you know, they start looking at the testing for last year, which, you know, is underway at this point for most clients. I think they're, you know, ramping up. So we don't usually hear from people for a few months into that process with the auditors, and then we hear the potential issues. So hopefully they're working with someone like Kristin that can be like, hey, this is an option for you.
And I think to your point, Laura, I think that's where we're all really, you're going to have to, everybody on this call is going to see their TPA, their auditor, their legal counsel all really join forces here, because we're adopting these provisions, especially retro to 2020, where you have a lot of time to do that on paper. A lot of your TPAs like Nova are going to be putting soft deadlines in there, you know, because again, if you say, oh, wait a minute, yeah, I want to go safe harbor for last year, you know, there's going to be some expedited testing, there's going to be some expedited auditing, and there's going to be a lot of quick decision making. And so again, that's, you know, we're excited to be doing events like this to be sure we're all on the same page.
Yeah, absolutely. And I think that's the key, right? Is working closely with your TPA on that to make sure, you know, what's that timeline going to look like? Can you do it in the timeline we're looking at, and making sure everyone's working together well in that. Absolutely. Yeah. Okay. Do we have any Q&A yet, or should I just jump into the late remittances relief?
Looks like we have one. It says, are you seeing delays in processing client census, or do you expect delays? Probably you, Cameron.
Yeah, we're not seeing as many delays as you would think from that, but we're seeing a lot of questions. You know, I mean, furlough questions in particular, right? Is from a data termination standpoint, right? What do I put here? Date of rehiring, what do I put there? You know, if there was a termination and then a rehire, does that affect things like eligibility, right? You know, and it generally doesn't. You know, it's sort of our rule of thumb is if somebody is eligible, it's hard for them to lose eligibility status. They got to be gone for a while, right? And so we're not seeing, that's a great question. And when we're not seeing a lot of delays there, we are seeing a lot of questions tied to the census data based on what happened last year. And so, yeah, when those questions come up, absolutely contact your TPA, and your account manager there should be able to help you. Great question.
Okay, well, I'm going to touch on the Department of Labor relief for late remittances that might be helpful to people for 2020. So a little section of the CARES Act that people may or may not have noticed amended ERISA Section 518, which gives the Department of Labor the ability to provide relief from different provisions related to COVID for up to 1 year. So we kind of have a statutory limitation on their ability to provide relief, which is interesting because we are coming up on 1 year now from when the pandemic started. And so the pandemic's not over, and the language in, you know, the relief is from, you know, March 1, 2020, and then ending 60 days after the announced end of the national emergency, which would be our COVID pandemic. That's the relief period, but statutorily they're limited to 1 year. So conservatively, we're telling people you've got that 1 year period, and then you give people 60 days for whatever this, you know, enforcement relief is. So one of the ones that you're going to see is that, you know, when your auditors are looking at your plan for last year and they're looking at how quickly you remitted your participant deferrals and loan repayments to the plan, and if they determine some of those are late, you're going to want to look at, did COVID create this situation? So did something happen in our process where, you know, say you normally have a person that's printing off and reconciling amounts, and they have to work with somebody else in person to do all these things, and then you remit the amounts to the third party administrator or your custodian. And that process couldn't work because of COVID and a lockdown, and you guys weren't at your offices, you were at home and you could not actually access what you needed to do that job. That would be an example of where the DOL is going to say, okay, that temporary delay, we're not going to take enforcement action. You don't have to treat that like a late remittance that would require, the lost earnings calculation and potentially the filing with the voluntary fiduciary correction program. We're going to give you a pass. But some of the things that they want to look at is, this was only because of COVID, and that you worked, as quickly as possible, as recently practical to get that remitted as soon as you could. So as soon as whatever it was preventing you from doing it was resolved, if you were remote and you just needed to get access to something to, change the process, once that's done, you remitted it, you get the enforcement relief. If you're just, not doing your job because you were distracted because of COVID and how weird lockdown was, that might not be sufficient, if you could do it remotely. And we also think it's going to be highly unlikely the DOL is going to go beyond the 15th business day of the following month for remitting. So we think this type of relief is really going to be, if you were a small plan, you have, your safe harbor 7-day provision and you went over the 7 days, it'll apply to that, but not beyond the 15th business day of the following month. And for a large plan, if you normally do 1, 2, 3 business days, anything beyond that, but again, not beyond that 15th business day of the following month. We just don't think they can go beyond that with their relief provision. So that's going to be something to look for, and it'll be, facts and circumstances analysis to see if you can rely on that. And to the extent you're going to, you will need to document that so that if you ever got a DOL audit, you can explain why you didn't report that as late remittances. And your auditors also might require certain statements from you on that in your management rep letter, and it might end up in your actual report. So
I think that's true. Everything you're saying here on this topic, I feel like is so important. I mean, given that probably late remittances is the #1, if not a top 2 violation of the plan document operations, if you will, do you feel like people are really going to be looking at that more so for 2020 than ever before?
I think so. I mean, because, if you think about it too, if the person in charge of, remitting everything, your, HR, payroll person, or whoever it is that's in charge of that process of reconciling and remitting, what if they were out because they were sick with COVID, or they were sick with something else, but their company says you can't come in and they're just not supposed to be working for 2 weeks and quarantining at home? Well, you might have, a 2-week delay on those remittances. So I think it's something that people should be focused on this year to see if, if those were the reasons. It's just like you would if, the DOL will give you some relief on something like the payroll person that always does this was on vacation and nobody else knows how to do it. You can get some, relief from that late remittance for, reasons like that. That's, it's a part of how businesses operate. And as long as it's not every month, the person's on vacation at the time that remittances should go in, which would be unreasonable. So yeah, I think it's going to be an important thing to look at. I think there's most likely for most of our clients in the beginning of the pandemic, there would have to be a disruption in the process because everything was just moving very quickly. And especially if you're on lockdown and not supposed to be going in the office. So.
Do you guys think we're going to see an uptake in, the utilization of a payroll provider or some type of cloud-based payroll that might be able to integrate with the record keepers moving forward to maybe eliminate stuff like this? I mean, I feel like those providers, some of the situations where there was integration already, I feel like are going to reduce the risks you're talking about. But I'm wondering those people that were on the fence in the past, maybe this is a good opportunity to revisit automating some of that.
Yeah, I think automating is helpful. I think the part that usually slows clients down is that the second person that needs to oversee, so they don't just have one person reviewing and confirming the deferrals are accurate. And so sometimes you want to have that 2 people, little checks and balances to make sure there are no mistakes. And I think with that type of manual oversight, I don't think you can get rid of that with automation because I think that's just there's still potential for errors that were in the entry process in the beginning, but
Sure.
it's possible. I mean, definitely, like, more you can automate and do less manual, less risk of human error for sure. And I think that just depends on the client's process with how they prefer to handle that kind of internal auditing oversight, I guess.
You're
Yeah.
giving me the perfect segue, Laura.
Well, yeah.
You're teeing up the audit conversation. So
Yeah.
I can move into that. If we're good on late remittances, I don't see any questions, kind of surprisingly, but hopefully that relief is very helpful to people. We anticipate it will be, so your auditors won't be, as on you about that this year. But you brought up some good points, with the audit. So one thing that we've been talking about is we definitely expect you to tell us that something has changed in your process, right? Something in your internal controls, something in your process has changed as a result of COVID. So it may not always be a good thing, but it's something we all need to be aware of and be able to understand. So if you tell us, and I'm talking to, our clients here, but if you tell us, that your controls are exactly the same as they were in 2019, I don't know that we're gonna, totally buy that. So just something to keep in mind. I mean, it obviously impacted all of us in one way or another. And so, how just be thinking about that, in these conversations on, what changed and what potentially, what risk is there, now that these changes have happened. So,
I guess the only exception to that, Kristin, would be if you have energy clients who were essential. So nothing probably would have changed because they stayed open the whole time and everybody still went to the office. But
you're right. Some people did stay in the office the whole time. I would still be surprised though, if nothing changed. Because I do think that just it's hard to believe that even if your specific operations didn't change, that something around you didn't, your providers or,
Right.
something, some element of the process. So
That's true.
that's a great point. But I think that's one of the things we're going to be looking for, as auditors, just because that's our job, is to be skeptical. But but I wanted to touch on something that Laura talked about. So the amendments, a lot of these amendments are not having to be put in place yet. So unfortunately, as auditors, we can't, necessarily have an amendment in front of us, and you guys as plan sponsors that are listening can't have an amendment in front of you to know exactly, are you following your plan document? Well, kind of you're not right now because you've taken these elections that we talked about with, CARES and Secure, and then your plan document's going to follow, right? So we're going to be looking closely at that too, just to understand, what did you change? So what provisions did you elect? And then we're going to be looking for those amendments to make sure that those amendments match, how the plan is operating. And that really hasn't changed in terms of what we find, in our audits. The primary finding is that you're out of compliance with your plan document in some way, shape, or form. And, Cameron touched on it. Late remittances is still an issue, but the even bigger issue that we see is eligible compensation. And if you've been to any of our other seminars, you've heard me talk about that because it's a huge problem. So I just had a plan the other day. It's not even a client yet. It was a prospect call, but they said, yeah, our board said that we can't defer on these wages. So we didn't. I'm like, well, what does your plan document say? Oh, that we have to defer on all wages. Like, okay, well, your board can't decide what your plan does, right? Like your plan document decides that. So just something to be aware of, as we always have been, but have a heightened awareness around what's changed with CARES and Secure and, how that actually impacted your plan. And then once we get those amendments, are we following the plan document still?
Right. I think to help, people like Kristin, help your auditors, you want to go reach out to your third-party administrator as soon as possible now and say, hey, what operationally is my plan doing for CARES? What are we operationally doing for Secure? Can you send me a summary? Or maybe they already have and they'll point you to that and on the portal, or, get that document so that you can provide it to your auditor and say, here's here's operationally what our plan has been doing since these dates. You know, it might be January 1, 2021, or it might have been, you know, March 1st or March 13th of 2020, you know, so it's like, just find out from them, what have they changed operationally for you that will result in an amendment likely in 2022, but retro to those dates. So she won't be able to review the amendments until a year later, 2 years later, but she needs those, you know, that information. If you don't have that list, go get it from your line administrator.
Yeah, really good point. Appreciate that. And then the other thing I wanted to mention too was on the partial plan terminations and late remittances. I think we kind of touched on it, but just to emphasize that, you know, documentation is going to be key here. And we talk about that a lot, but you know, if it's not documented, it didn't happen, right? So if, like Laura was talking about, if you know you had some late, what we would usually consider late remittances, just make sure you've got documentation on, you know, why you think that they weren't late, for us, but also for the IRS and DOL, you know, audit that may come down the road. And then same thing with partial plan terminations. There is a calculation that's done, like I said, usually involves ERISA counsel. So just making sure you have documentation if you did have significant reductions of force, so that you can show, you can demonstrate that you did not have a partial plan termination, or if you did, you know, you have that calculation to support that declaration. So those are the kind of the two big points that I wanted to make on the audit side. And I think we are kind of getting into our last
So
section
there's
here.
one other one for your kind of section. There is relief on operational failures related to plan loans or distributions. So if you had any late plan loan issues that came up in 2020, or any late distributions, or any kind of operational failures related to that were related to COVID, you want to document that and then give that to your auditors as well and say, look, this happened, but pandemic, we're relying on the relief issued by the Department of Labor, so that these are not issues. So just throwing that one out there.
Yeah, thank you. Yeah, so we want to make sure we leave time for questions, and we don't have any that are popping up right at this moment. So I know Cameron has some things we wanted to share on RMDs, and we do have a couple other content items, but I definitely encourage y'all to ask questions as they come up.
Yeah, the only thing I wanted to see on the RMD, and Laura had touched on earlier, the delaying of it with CARES. You know, I think the big question we all got right away was, all right, if I delay my RMD, does that mean there's going to be some type of double down, right, the next year? And that answer is no, you know, so that was a huge question that we consistently got when that passing came out. And so there's not going to be a double down after the fact with the delay of 1 year of RMD. And then you've also got the Secure Act saying that the RMD age, which has always been 70 and a half, is now 72. And so then we got a lot of questions there on, okay, well, does that apply to me or not? And really kind of the magic date is where you were on December 31st of 19. If you were already 70 and a half and you were taking the RMDs, you're not affected by the change of 272 from 70 and a half. If you hadn't started taking ARM days yet, or you get to delay those to 72. So those are things that obviously your TPA, you know, we are in this restatement period right now on the TPA side of things. And as those of us that have had a plan for a while know that every 6 years, you're required to restate your document, regardless of how long you have been around, right? It was a 2008 thing, 2014 thing, and here we are in this new restatement window. And so ideally your TPAs are coming to you guys talking about these changes, right? Because the reality is the new, and Laura, correct me if I'm wrong, this new document that everybody's being restated on was actually approved prior to Secure and CARES. And so the reality is when you get restated on this document, there's going to be another conversation about, hey, are we going to continue to adopt anything you might have adopted last year? Or, hey, let's revisit this conversation because we're restating your document. So,
yeah, I think you're going to see those like standardized plans that were pre-approved by the IRS, and then you're going to have another like an amendment that will be pending approval by the IRS, and then they'll come back later with any changes that the IRS required for that standardized amendment. But yeah, you'll definitely see that probably as a snap-on, you know, Secure, CARES, Consolidated Appropriations Act, everything that they want to address.
Sure. So yeah, it's a great time to be taught. If you've got questions, I saw the poll a lot. It was like an equal spread on I have questions, I don't have questions, or I might have questions. Ask your questions, right? This is the best time to ask the questions given where we're at, sort of in a debrief period, waiting to see if new things come out. And then obviously the restatement period. Now is a good time to talk to your TPA, have them get in the weeds if you want to get in the weeds on securing CARES, as well as the team on this webinar today. So
yeah, and I also think you want to talk to your TPAs about what notifications they sent to your participants, on operationally what they've done for CARES and Secure and everything, so that you know that your participants were put on notice. And if they didn't send anything on the plan's behalf, then it's a good idea for you guys to get a notice out to say, operationally, we started doing this, and the plan will be amended no later than your calendar year plan, December 31st, 2022. For non-calendar, it's your last day of the first plan year beginning on or after January 1st, 2022. So that's your deadline to technically amend your written plan document, but you really want to put participants on notice. Hopefully everybody did that if they did adopt any of the CARES Act provisions, because no one's going to use them if they don't know about them. But that's something you want to talk to them about and get out those notices as soon as possible.
We do have one question, guys. So I think probably this is more so for you, Cameron, but it says, are you saying we all should be having an amendment or restatement for our 2020 filing?
it's not tied to the filing itself, if you will. The whole point of the restatement initially is you've got these periodic required interim amendments that come out over time, right? And so then then changes in provisions and what's offered, right? And relief based on a number of different things, like disaster relief, like military things, like COVID, right? And so where you get all these different periodic amendments throughout the years, at some point, what we're trying to avoid is your base plans document and this appendix stuffed full of amendments, right? And so every 6 years, what we're basically going to do by law is consolidate it all and plug it all in. This is the time to make the changes at the top level, and then it trickles down to all of us. This restatement does not require people to make changes, not necessarily, especially on anything that was discretionary and not required, right? This is just the time that we're all going to restate on the brand new document that just got released. And because it's required based on a calendar year thing, so it doesn't matter. This is not dependent on the effective date of your plan, right? Your plan may have been effective 1/1/18. You're still going to restate right now. And so this is just a time to talk to the TPA about what's new that's come out. It's a good time to evaluate your TPA to see if they've communicated to you guys what is new that has come out, and decide what you want to adopt and don't want to adopt. So the long answer to that short question is the restatement required? The answer is yet. Is it tied to your 2020 or 2019 or a prior year 5,500? The answer is no.
Thanks, Cameron. I think that's helpful. We have one more polling question we wanted to throw out there. We have a little bit of time left while you come up with some more questions for us. So what's the outlook for 2021? We're just curious to hear from you. Do you feel like you're fairly used to your new normal, still struggling, unsure if the company or plan will continue to exist, or expect little to no improvement over 2020? Give you a few seconds to get your responses in. And I just wanted to say again, we have about 10 minutes left and we want to answer any questions you have. So I encourage you guys to type those into the Q&A. Okay, we've got results. So most of you feel like you're fairly used to your new normal. So that's great. About 11% still struggling. 4% unsure if the company or plan will continue to exist. So that's good. We want to see that low. We want to keep working with all of you and expect little to no improvement over 2020. We've got some pessimists in the group at 11%. So rightly so though, right? I think we all feel that way a little bit. We're still in this. So while I think most of us have seen some improvement, there's still a lot of uncertainty on what lies ahead, for most of us. So Appreciate your responses there. And I think we're still waiting for some questions to come in. If you have any of those, we have a few minutes left in our time.
I'll mention one more relief provision that just people should be aware of. It doesn't come up a lot in the retirement plan context, but it could. So one of the joint notice between the Department of Labor and Treasury, IRS extended some timeframes for plans. A lot of those dealt with welfare plans, so things like COBRA elections and the timing of providing notices and all those things. But one of them actually does apply to retirement plans, and it relates to the claims and appeals process. So if somebody wants to file a claim or an appeal, and that claim or appeal right was during March 1, 2020, or anytime through the current date, they will have 60 days until after that 1 year statutory limitation on March 1st. So they can file that claim or appeal, even if it would be considered late under the terms of your plan, until April 30th, 2021. So just keep that in mind, that if you're like, oh, this, person, they submitted a claim for a retirement benefit and we denied it, and they only have however many days under your plan to appeal that, and that expired. Well, it didn't really expire yet. So the relief says you aren't allowed to enforce that deadline until 60 days after the pandemic ends. So they still have time to do that. We are recommending for some of our clients that are in that situation to go ahead and send a notice to participants to remind them that their deadline to file claims and appeal that would have expired during that period will have until April 30th, 2021 to submit those, just so that you have that hard cutoff date and people don't think they have until the end of the pandemic and then 60 days, because ultimately, statutorily, they do not. So just something to put out there. It doesn't come up a lot. It's very rare we see claims under retirement plans, but it can come up. So
Thanks, Laura. Appreciate that. And I think since we are not seeing any questions come through from the audience at this moment, Cameron, I know we had a few that we maybe didn't touch on yet that you could take a couple of minutes to talk about. I think you did talk about adopting a plan now for the prior year, but maybe on the credits. I don't think we touched on that yet.
No, I mean, and I think most everybody that's a part of this plan or part of this call has a plan, but, part of my role at Nova is kind of like a sales guy, if you will. And so we're always out there trying to encourage plan sponsors to adopt a plan. And a lot of the pushback we get from people who don't have plans are they're expensive. Right? They're just expensive, And so one thing that the Secure Act did, there has always been this startup plan credit for brand new plans. In the first 3 years the plan's in place, you could get a credit of up to 50% of your out-of-pocket costs. That up to it, not to exceed 50% of the total, also not to exceed $500. They reversed that. And so now the minimum credit is $500. And the credit itself now is actually calculated at $250 per eligible non-highly compensated employee. So that's any non-keys that made less than $130,000 last year. But, if you can get, it's still capped at 50% of your out-of-pocket costs, or I think $5,000. But, for the most part, if you've got, 10, 12 employees and that are eligible and you apply that credit, generally the credit accounts for 50% of the cost of these plans. And so we're like seeing that in one of my roles at Nova as a TPA in the adoption of new plans, because the plans are much more cost competitive than they used to be, right? And so that's just really neat in helping people determine whether or not they want to plan. Other than that, and there's even more if you add there's even a more enhanced credit if you offer an automatic enrollment feature, which is nice for those of us that like automatic enrollment. Other than that, the last thing I'll kind of summarize, from the TPA side of things is, especially looking at that poll, the last few polls, in fact, some of us are still being affected. Some of us are a little skeptical on how things are going to play out. And the last thing we want to do is let people go. As we're sitting out there as account managers trying to provide advice on how to keep that plan up and running. How do we reduce the risk of having to let people go? With the COVID-related distribution thing being done, and we're in a restatement period, if you don't offer hardships, now might be a good time to consider offering a hardship provision, right? People can't just take a CRD now because they're a COVID-related person, right? So maybe you consider in the restatement of your document anyways, add a hardship provision. That might help people, right?
I'm actually seeing that for one of my clients. Actually, they historically are very like, we want to protect our employees and we don't want them to use any of their money in the retirement plan for current expenses. We want them to save it for retirement. This is why we have the plan. It's just for retirement. And they've had so many inquiries during COVID. People want to get their money. And it's just like, it was so constant throughout the year that they just called me this month and they said, hey, we think we want to add hardship distributions to our plan. Like, let's talk about amending it and kind of the scope of things. But it's like, it's a shift in the company's kind of culture where it's like, we thought we were helping people by making them wait till retirement, but they're like, we know our people need help because we don't know what's going on, say with their spouse or their children or, you know, whatever outside of that, right? They know like they didn't like fire anybody. They're like, we've been fine. But they're like, we don't know what happened. Like maybe their spouse lost their job and they do need the money from the retirement plan. So we are seeing that coming in now with redesign, you know, around what happened last year with COVID and just kind of feedback from participants on what they want, you know.
I appreciate you sharing that, Laura, because the reality is, you know, just a lot of people waited to request a CRD at the very last minute. And where we all had imposed deadlines of basically the 28th of December, you know, I think one of the issues we had is we weren't on the same page and all trying to provide additional grace. And so I think a lot of people, both at the TPA level and the record keeper provider level, were still accepting forms and accepting requests, but not all of those got processed. And so we're very busy and proactive right now, to your point, Laura, and trying to work with people on, hey, could this be deemed a hardship? And if so, is this a conversation we need to be having with the plan sponsor?
Right, right.
Cameron, I have one quick question for you about what you said about the auto enrollment. Is that credit only for a new plan?
I'm under the impression that, so that's actually a gray area. You know, I've gotten different answers on that where if I'm an existing plan, can I apply for that credit up and running, or can I provide, or do I have to be brand new, or you know, when we say brand new, we mean effective 1/1/2020 or after. I believe it's that new credit only applies to plans effective 1/1/2020 and after.
Got it. Okay. And then we have one quick question from the audience. Thank you, Leonard, for all of your questions today. Do you foresee any major changes in plan fiduciary roles? I don't know, Laura, you could touch on this real quickly before we close out.
Yeah, I mean, I expect there will be a lot of changes now with the Biden administration being in, but you know, they have a lot on their plate in the first few months of that. And I think if we're going to see anything, it's probably going to be like in 2022 and beyond. I wouldn't be surprised if there's going to be more rules around that. I haven't seen anything that's come out that, people are saying specifically, what the plan will be, but that is, going to be a focus, I think, of this administration.
We're seeing a big uptake, when we talk about the 316, 321, 338 conversations, we are seeing an uptake in that 316 conversation. Less about investments, more about operational. That ties into a number of things that the three of us said on the call today is, okay, I had this issue because of COVID, or this issue because of a partial plan term, or this issue because we had to let people go. And now that we're trying to recover from that, whether or not we get relief for 2020, how can we automate some of this? How can we outsource some of this to maybe somebody that can step in a co-fiduciary capacity? So I think we're going to really continue to see an uptake in outsourcing some of the operational duties that are tied to these.
Yeah. Like the current fiduciary duties, outsourcing. We definitely have seen that trend in the last few years. A lot of our clients looking to those options that just, they don't have the committee type resource in-house to manage that.
Absolutely.
Mm-hmm.
I think that's great.
All right. Well, we're just about out of time. So I'm going to turn it to Jen to close us out.
Perfect. Thanks, you guys. What a great discussion today. We really appreciate it. And CPE certificates will be sent via email to all attendees within 2 weeks. If you're an HR professional, the certificate may also be submitted for your continuing education credits to whoever your regulatory body is. If you attended via phone only, please send an email to jlemansky@pkftexas.com indicating that you would like to receive CPE credit for this webinar. Additionally, since there was so much great information, this recording will be posted to the PKF Texas YouTube channel later this week. And please be advised, if you forward this to anyone, watching the recording will not qualify them for receiving CPE. When this webinar ends, you'll receive a pop-up link to an evaluation. Please take a few minutes to provide your feedback as well as share topics you'd like us to cover in future sessions. Your feedback is valuable and helps us design future webinars. The link for the evaluation will also be provided in a follow-up email, again, coming later this week. Thanks, everybody. Thank you to our panelists again, and I hope you have a great rest of your day.
Thank
Thanks,
you.
everyone.
Bye-bye.
Bye-bye.
Thank you for watching this recording of our Zoom webinar. A quick reminder that watching this video will not qualify you for CPE credit. For more information about PKF Texas's upcoming webinars, contact jlemansky@pkftexas.com and stay tuned for future topics.